This is the Alhambra Investments Weekly Update for February 15th, 2019. This past week, Congress passed and President Trump signed a bill to fund the government and avoid another shutdown. But the bill does not have the funding President Trump requested for a border wall, so he has declared a national emergency to get the funds. We expect a court challenge. Small business optimism fell more than expected in January to the lowest level in 26 months. The fall in January mainly reflects a drop in expectations that the economy will improve, a drop in sales expectations, and a drop in plans to increase inventories. Job openings surged in December, up nearly 30% year over year. Hiring was also up, but at a slower pace. The gap between openings and hires is at a new record of 1.428 million jobs. Inflation remains subdued at both the consumer and producer levels. Both readings were less than expected. Retail sales for December were much less than expected, down 1.2% from November. Almost all categories were negative, with the exception of vehicles. The market didn't react much to the report since it was for December and probably contained some angst about the pending government shutdown. A more current report showing some weakness was industrial production for January, down 0.6%. The poor reading followed an exceptionally strong report in December, so there wasn't much impact. In markets, crude oil and the commodity indexes continued their winning ways. Crude was up 3.36% on the week and 19.8% for the year. The GSCI is up 12.1% year to date. Small cap stocks continue to lead U.S. markets higher, up another 4% on the week and nearly 15% for the year. The S&P 500 is up nearly 10% year to date, but still about 5% below the all-time high set back in September. The U.S. dollar was slightly higher on the week and the year. Not surprising, with Germany reporting a flat GDP in the fourth quarter after being down in quarter number 3. Europe's economic data has been weak, but stocks in Europe are still higher on the year. Markets are closed Monday for President's Day. Economic reports will continue to play catch-up next week with the release of the December durable goods report. Markets will likely look past any weakness, just as they did with last week's retail sales report. The most important release is probably the FOMC minutes for the January meeting. Investors will be looking for clues to future Fed moves. Here in Alhambra, we don't see anything that changes our mind about the outlook here. The yield curve has stalled this year, but the longer-term trend is still toward flattening. We're far from inverted, and we don't see any movement that is indicative of imminent recession. Credit spreads have narrowed some this year as risk appetite has returned. Overall, we continue to see economic growth falling back to the trend of about 2%. Stocks have performed well so far this year, but earnings growth in 2019 will be challenging. While we see little reason to expect recession or a bear market, we also don't see any reason to expect large gains from here. The key factor to watch from here is the dollar. Its direction is likely dependent on the outcome of trade negotiations. The negotiations with China continued last week, with President Trump saying it was going well and he might extend the March 1st deadline by 3 months if that continues. While we don't think any deal with China will have much impact on the trade deficit, the markets will react positively to a deal announcement. We expect foreign markets to benefit more than the U.S., as the dollar should decline once a deal is struck. Once a deal with China is done, President Trump will likely turn to Europe, where he has repeatedly threatened tariffs on autos. The Commerce Department will be delivering a report to the President next week on auto imports, and it's expected to endorse tariffs on national security grounds. We don't understand that either, but cabinet members generally give presidents what they want. That's our report for this week.